Welcome back to Overnight Accountant's course on Realtors and Reducing Taxes. In this course, our goal, as you well know by now, is to help you stay in compliance with tax regulations, but also minimize the amount of taxes that you have to pay. If I haven't said it enough, and I'll keep saying it again, every $100 in deductions you find from taking this course will save you $43, roughly between $30 and $43 in taxes. So let's find you a bunch of extra deductions. Now in this section here, we're going to go over a brief overview of income and deductions for realtors. In this course, we're going to go over income, which is relatively simple for most realtors. But then we're going to define what a deduction is. So this is a little academic. Before we dig into like each line item on your Schedule C, we just want to do a brief overview and hopefully help you understand what is deductible and what is not, or what is the definition of a deduction. And we're also going to briefly go over what is called startup expenses. Many realtors don't realize if you're new to real estate and this is your first year in business, all the expenses that you incurred before you actually started selling real estate are in a certain classification called startup expenses. As I mentioned earlier, if you are been in real estate for many years, you can probably just skip that section when we get to it. However, it is included in this section of the course. So let's move forward. We're going to start by discussing method of accounting. Now, as you may recall earlier, I said we're not going to be discussing accrual basis accounting in this course or for accrual basis taxpayers. You are most likely, as a real estate agent, you are going to be what is called a cash basis taxpayer. Very, very few exceptions to this. I would bet highly on the fact that you are a cash basis taxpayer. Well, Brett, what does that mean? All right, what that means is you count your income when it's received or is available to be received. Let's look at it in the terms of a real estate agent. Basically, it's going to be when you receive your commission check from your broker or it's available for you to pick up from your broker. That's going to be like 90% of where your income is going to be coming from. If not more than that, it's going to be those commission checks. That's what you're after. And that's when you count it. And you're not really going to have to worry about it too much because they're going to put that on your 1099. Now, you may want to look at your income in your checkbook and make sure it matches up with what the 1099 is to make sure they're right. Definitely you don't want them reporting more than they have to for income for you. You do want to cross-reference it, and that record keeping and that little method of accounting that we went through earlier, that little bookkeeping thing we did in the earlier section, that should hopefully help you be able to match what your broker reports to you with what you actually made. Now, there may be instances where that doesn't match up. Maybe you had a closing on, December 30th. You haven't received the check yet, but in their accounting software, it's in there. That really would still count for the previous year because it was available for you to pick up in that year. I wouldn't really concern yourself with it too much because it's really a matching thing. What you don't report in one year is going to report in the next. However, you want to make sure most of all that it matches that 1099 miscellaneous. Okay, expenses. Cash basis accounting or cash basis taxpayer counts their expenses when they are paid, when they are physically paid, or you incur a debt to pay the bill, and that bill is paid by a third party. And what that basically means, you put the expense on a credit card. You take a loan out and pay the expense. You purchase a tractor or something on payments, and that payments you're paying to John Deere or whoever you buy the tractor from. That is an example of incurring debt to pay a bill. And cash-based taxpayer, you incur that debt that is the same as actually paying the expense. Okay, very good. Okay, let's go over a little bit more detail on income. Now, income for a business, according to the IRS, it's going to be reported on your 1099 received from your brokers, and they're required to give you a 1099 if they pay you over $600 during the course of a year. It also includes, however, all other inflows of value to your business, regardless of whether you received a Form 1099 miscellaneous. So it's important to remember whether you received a 1099 or not. Let's say, for example, you only received $500 from your broker, and they didn't give you a 1099, you still have to report that $500 as income on your tax return. So what does income include? Most of your income, of course, as a real estate agent is going to come from commissions. However, there are certain instances where you may receive a finder's fee or some type of other commission or a fee for helping someone find a buyer or a seller. So finder's fees would count. Freelancing, that can be kind of broad. Anything you might be doing to real estate that is outside the normal broker relationship that brings you in money related to your business, that is income to your business. Maybe you do some public speaking. Maybe you do some teaching. Maybe you do public speaking on real estate issues. with the hope of using those, even though you're paid, oftentimes your hope is to garner business or increase your presence in the marketplace to others who may use you or refer you as a real estate agent. Any income you receive from those items are included on your Schedule C. Now, with one exception here, let's say you have a separate business, and that separate business is speaking and teaching, and it really rises to the level of being its own business. You would take those fees and put them on a different Schedule C, which would be for that speaking or teaching business. Enough said on that. Okay. It also includes all payments related to your business from all sources. So all payments related to your services as a real estate agent go on this form. Okay, how can you get paid? You might get paid with a check, cash, maybe electronically, maybe they put the money in your account automatically. However, a method of income, which a lot of folks don't know, and I'm not going to go into it in great detail, is what's called barter. And what that means is that is really, including your income, is the fair market value of any products and or services. Now, products really wouldn't actually be a barter. Barter is really where you exchange services with each other. Let's say, for example, I prepare a tax return for my web developer, and my web developer in turn develops me a website. We kind of traded services. So the fair market value of the services I provided for him would be income to him, and the fair market value of the services he provided to me for the web development would be income to me. That's basically what a barter is. However, what if you're paid in a product for your services? What if they gave you, I don't know, think of something they might give you. I don't know. If they pay you in a product, though, the fair market value of the product is income to you. So just be aware, it's very rare. Just want to make sure you're aware of that. Okay. Now, what is not Schedule C income really is interest on your business checking or savings. So if you have a business savings account, remember we discussed having a savings account for your taxes, and it's hopefully it's an interest-bearing account. You make a little bit of interest off that money during the year. That's not Schedule C income. The same if your business checking account. That really is reported on Form 1040 on line 8 as interest income. Even though it's going into your business checking account, that's an exception. That's not really income that you earn for providing a service or operating a business. That's income, your business money earned as interest. So it's reported as interest. Rents may be another area. Let's say you're a real estate agent, you also have one rental property, or maybe you have two. Income you receive from those rentals goes on Schedule E, which is for rents and royalties. If you've been in business for a while, you're probably already aware of that. And the only exception to that would be if you are a real estate professional, which is a certain class of real estate, not always real estate agents, but you are definitely in the business of real estate. That would actually be included on Schedule C, but we're not discussing real estate professionals in this section, in this course. If you want to learn more about it, we may have another course for you to check out, or you may need to talk to your tax professional about being a real estate professional. Okay, credit card points and rebates. A briefly note on this: if you use those credit card points and rebates, if they're business related, it's not income on Schedule C. What this is actually is a reduction in the purchase price of whatever you're purchasing. Let's just say, for example, real quick, I have an Amazon Visa card that I use for business. Let's say I have 100 points on it, and I use those points instead of paying for the items on my credit card or adding items to the credit cards. I use my 100 points or my $100 on my Amazon Visa to buy office supplies with. That's really not income to me. However, I cannot deduct the office supplies that I purchased with it. I got the office supplies, but I used cashback bonus to buy those. So it's not a deduction, but it's not income. So just want to make you aware of that, credit card points and rebates. So that's it for this section. Now what we're going to move over to is we're going to talk a little bit about deductions. So we just got done a brief overview of income, and that's really all we're going to discuss on income, because 90% of you guys, your income is going to be reported on a 1099 miscellaneous from your brokers. Schedule C business deductions. We're going to go over this in a little bit of detail and just very broad strokes here. We're going to discuss deductible expenses. So what is a deductible expense in, I guess you would say, tax theory, or according to the IRS? What it is a deductible expense. To be deductible, an expense must be what is called ordinary and necessary for your trade or business. Okay, ordinary and necessary, that's great, but what does that mean? Okay, according to the IRS, an ordinary expense is common and accepted in your trade or business. This is something that other real estate agents do in their business. It's items at the expense. It's ordinary. is common and accepted in the industry that you're in. Necessary. All right? What necessary means is it's helpful and appropriate for your trade or business. So I'm going to put this in kind of layman's terms here. Hopefully it's layman's terms, because this is very gray area, and you kind of know what, it's kind of like you pass a smell test. You know what expense is when you see it. But in other words, it's money you spend to operate your business with the intent of some point of generating a profit, and you can prove that money was spent to operate your business with the intent of generating a profit. So it's money you spend on your business to keep the doors open, and hopefully through advertising or whatever to generate more money than you spend to create a profit. There is a very broad definition of what an expense is. Now, I do want to make a note here on reimbursed expenses. If the amount is included in income, let's say, for example, you go to the store and you buy $100 office supplies, and your broker pays you for those office supplies. So you're buying it for the main office, you give him a receipt, him or her, and they give you $100 back as a reimbursement for that expense. If the amount is included on that 1099 they give you, so you often have to ask is what that includes. If it includes, it's included on your 1099, what I mean there is if it's included in income on your tax return, you can deduct that $100. However, if that amount is not included in your income, and most likely that reimbursement from your broker, if they do not include it on that 1099 miscellaneous, you do not get a deduction for that, because they have paid you back and they didn't include it in your income, so you don't get deduction because it's not included in your income. You got paid back for it. So it's basically a wash, tax-wise. Now, in the event that the expense, the amount of money you spend, that $100, is greater than the reimbursement amount that is included in your income, you can deduct the difference. So if I spend $100 and I'm paid back $50, and that $50 is not, that I'm reimbursed, is not included in income, I get to deduct $50. Okay? This can be very confusing. I'm not going to go into that great in any more detail, because I confuse myself when I talk about it, try to do an example. However, the point here is if the reimbursed expense is included in your income, you can deduct it. If the reimbursed expense is not included in your income, you don't get a deduction. If you think about it, it's kind of common sense, but those are the rules, and this is one rare example in tax law where it does match common sense. Okay, what's not a business deduction? Many folks in business for themselves are surprised to learn that the value of your time or your expertise given away to clients or to a charity are not deductible. So if you spend the day instead of selling real estate, you spend the day going, to Goodwill and helping them out, or teaching some folks at a charity about real estate, you may in your mind you've lost money. However, you do not get to deduct that. You didn't have any income come in to offset it with that expense. And remember, a good way to look at, if I haven't discussed before, a good way to look at how the taxes work on your tax return is really to deduct something, it first has to be income. You actually have to have an economic outlay. You have to give something up of value, tangible value, and the value of your time really is not an expense on your tax return. So I just want to make sure you're aware of that. Also, and I hate to tell you this if you're new to real estate, but I'm going to mention this several times in this course, classes you take for the real estate exam or to learn about the real estate exam are not a deductible expense. And that is because in IRS rules, any education that you take or that you have that qualifies you for a new profession is really not an expense. So you can't deduct those classes you took or the exam fees. You cannot deduct those on your tax return. I just want to make sure you're aware of that, because most realtors, many realtors rather, really don't understand that, and they have a hard time with it. But it's the truth. You can't deduct them. As I just mentioned, cost of the exam is not deductible, no matter how many times you take it. Hopefully you just took it once, but if you took it 10 times, you still can't deduct that expense because it qualified you for a new profession. All right, that's it for this section. Let's go in here. We're still discussing real estate business deductions, and we want to discuss categorizing deductions. When we're discussing this here, what we're doing is the most important item we want you to know is what is deductible and what is not. Okay, that's really what we want you to know. That's what's going to save you tax money. All right, but placing the deduction in the right column is also very important to put it in the right area of your tax return, because we also want you to avoid questions and red flags and correspondence from the IRS. So knowing where to place it, so your tax return for real estate agents based on that business code we discussed earlier, is kind of what the IRS is expecting to see, or at least within the margins of what they would call error, to avoid you getting some kind of question on your tax return. So it's very important that you know where to place on a tax return. What we're most concerned about, however, is that you're able, through proper record keeping, you improve your deductions anyways. But we want you to understand what is deductible and what is not. Schedule C categories can be confusing as we go through this course. Oftentimes I'm going to say some items as we go through the course, you say, well, should it be deducted here in advertising, or that's supplies. What we want you to do is get yourself in the mode of asking yourself, what was the expense for? Why did you spend the money? Oftentimes that'll lead you to the proper category of where it needs to be reported on your return. Now, as we go through this course is basically going to follow Schedule C. Now, in upcoming sections, you're going to see where the major deductions are kind of put together, like auto and the home office are kind of together, but with few exceptions, we're going to follow Schedule C. So you can probably just print out a Schedule C from our website and follow along for the most part on the course as you go through this. So also familiarize yourself with Schedule C. All right, startup costs. I want to go over these briefly. If you're new to the business, this is going to be important for you. However, if you have been in business for years, you can go to the next section right now. But let's discuss startup costs for just a few moments. What startup costs are, and many real estate agents and business in general, these are a special category of costs. And these are costs incurred before you go into business. Before you go through the licensing process, you get your E&O insurance, you get the multi-listing service or whatever you're doing. This is before you really are out there. You don't have to get any listings yet to be in business, but you haven't really offered your services to the public yet formally. The costs incurred before you go into business. It's going to include research and books to learn about your profession. See if this is the profession for you. Costs incurred before you officially start your business. This can occur like, hey, you're traveling to find a broker, you're getting your licenses, you're doing all that. You have to get your E&O insurance. You just haven't started to offer your services to the public yet. So all these costs before you start in business would be what's called startup costs. Now, the good news is that you can deduct up to $5,000 of startup costs as an other expense in the first year. So really, you lump all these expenses together, and hopefully most real estate agents, you haven't had more than $5,000. But you can deduct those as another expense, just call it startup costs, as an other expense on your tax return the first year you go into business. Now, if you have over $5,000, this can get a little confusing. If you're using software, you got to make sure you're doing it right. Make sure your tax professional knows, because it's probably the first year you're using a tax professional for this business, which we highly recommend. Make sure they know what your startup costs are, and they should know what to do with them. However, if you have over $5,000, you got to take that difference, and it is what is called amortized, which means it's basically divided up by 60 months, and you get to depreciate, well, amortize. It's another term for depreciation of an intangible. We're not going into that, but you get to basically break those expenses up, that amount over $5,000, and divide it up over the next 60 months. So basically it's 5 years you take the deduction for when you start business. Okay, here's a little tip to help you minimize startup costs. Postpone a lot of purchase until you start to sell. So if you're buying a lot of supplies, spend a lot of money on advertising, even before you've started the business, to avoid confusion and maximize your expenses for your first year in business, postpone all those purchases until you start to sell real estate. Like, don't start renting a bunch of billboards for even able to sell real estate. That might be, it's kind of what I'm saying. Okay, there you go. Like large purchases, I want to make sure we're large purchases. Say let's say before you start business, you're making some purchase. You buy a computer for $1,500. Maybe you bought a really nice camera to take pictures of your listings and all that kind of stuff. Maybe you purchase a drone. Really getting high tech there. Maybe you got a drone. You got it even before you started business because you're so excited about real estate. If you purchase over $500, it's kind of an item a number we use in this course, see whether something should be depreciated or not. Those purchases may need to be depreciated, and that depreciation starts on the date you formally start your business. So those expensive items really aren't going to be considered startup costs so much. They're actually going to be depreciable assets, which you're going to have to depreciate according to the terms of depreciation, and that's a separate part of this course. So I just want to make sure you're aware of that. Classes to become a real estate agent, as I said just in the same section earlier, and the exam fees are not deductible. Education costs for a new career are not deductible. However, this course is not about other credits and whatnot, but I want to make you aware that this course, the courses you took, not the exam itself, but the courses you took at a qualified institution may qualify for what's called the lifetime learning credit, which can be a very valuable credit if you took those courses at a qualifying institution. Now, what is a qualifying institution? It is really, you read along with me here, any college, university, vocational school, or other post-secondary educational institution eligible to participate in student aid program funded by the IRS Department of Education. In other terms, it means they're accredited, and they can take financial aid from other institutions. Best way to find that out, I believe the IRS has a website, but ask the institution whether they're accredited or not. You should know whether they are or not. But anyways, if you did, you're going to qualify for that, possibly qualify for that lifetime learning credit, and we want you to get that if you can. So that's it. That's it for this section. We're going to dig more in other future sections into specific expenses, which should be very exciting. We're actually going to start helping you to reduce your taxes line by line coming up in future sections.